Private equity funds have in recent years increasingly used a particular financing technique, namely the bridge financing at the fund level. This is basically a structure that allows private equity fund managers to fund investments they make with an immediate debt financing until they will ultimately call the capital from the private equity investors that have committed to their funds, which seems to be a technicality actually has important implications for how private equity funds perform and how we are able to assess the performance of those private equity funds. These bridge facilities by themselves are subject to lots of debate in the asset class. Some investors like them because they tend to increase the annualized performance of their investments. Others see them a little bit more skeptical because at the end of the day, private equity funds borrow money on behalf of the ultimate investors, but these investors may actually be quite cash rich and would like to have their capital at work in the private equity transactions. This debate notwithstanding, the use of private equity bridge facilities has a very important consequence on how private equity performance is measured, in particular how annualized performance is measured. And I would like to briefly describe how they can be quite distortive for the way we usually assess performance. If you look at a simple example here of a private equity fund which makes two investments at the same point in time and then holds those investments for a number of years in its fund, returning capital to the first investment after only a year, and having the second investment exit after multiple years, we can immediately identify the impact of the bridge financing. If this investment happens after only 1 year, the return measured in IRR becomes very high. This is due to the fact that the internal rate of return methodologically pays lots of attention to what happens in the very early years of the life of the fund. Now, if we assume the same situation of this fund without a bridge facility which in this case has pushed out the first capital call by an entire year, we see that now all of a sudden the time between the initial capital call to investors and the distribution from this first investment doubles. It goes from 1 year to 2 years, and consequently IRR is decreasing quite dramatically. This particular aspect, the link between the bridge facility, which is condensing the time between the first capital call and the capital return, and then the particularity of IRR, which is too sensitive to the early moments of the life of the fund, triggers a performance bias. Because as we'll see in a second, the increase in IRR from 24 to 38% in this case doesn't really reflect economic reality. To understand this, we got to look at a different way to look at returns, namely the technique to measure annualized returns not based on the internal rate of return, a widely used yet quite problematic performance measure for private equity, but through a different performance measure, which simply analyzes returns by looking at how much money was generated in a multiple terms, in terms of TVPI or MOIC as the industry measures it, and then looking at the actual duration of the investment. The duration defined as the point in time between the average capital outflow and the average capital inflow, which can simply be measured by looking at all the inflows and outflows and calculating capital-weighted averages of both. So we get explicit dates. The money may go out in the 3rd of June in 2000 and come back on the 20th of December 2005, or we can count the number of days between this as the investment duration. In the stylized example here, we have a case where the money is multiplied by a factor of 2.1, and the amount of time it takes to achieve this money multiplication is 4.4 years. We can then use this to do very simple math to just look for the annualized compound performance that over 4.5 years leads to this capital multiplication, and we get the annualized rate of return of this investment. This rate of return importantly captures the annualized return without the bias that the IRR introduces, and we can look at this rate of return in our two examples, the example with or without the bridging, and we see immediately that while the bridge also alters the rate of return, its impact is much, much lower than for the IRR. To make it simple, the IRR sensitivity, the IRR bias, is particularly influenced by the bridge facilities, which can lead to a substantial distortion of returns. Now, if you look at this more systematically with real-world data, you see very quickly that this is not an isolated phenomenon. Having looked at a large number of mature private equity funds and simulated the impact of a possible bridge, we found that there's a large number of funds where the impact can be quite dramatic, can be distortive for investors to the point that they can no longer have a clear view on the performance of these underlying funds with the IRR measures. So there are two possibilities for investors to react to this. You can try and get information on the unlevered funds, on the unlevered cash flows of this fund, and therefore calculate the unlevered performance of those. But if this may be difficult, you can also just switch to a performance measure that's less sensitive to this phenomenon. And if we simulate this on the sample of underlying funds, we see that mathematically we cannot make that performance distortion go away entirely, but we roughly cut it in half and we avoid the most extreme distortions. The Private Equity Observatory of HEC has been collaborating with the ILPA, the Worldwide Association of Limited Partners in Private Equity, to make that calculation technique available exclusively to their members through a calculator simply implemented in Excel, allowing them to calculate and benchmark the returns of private equity funds on that superior performance measure.